Burberry reported its best quarter in 3 years on Friday, with comparable retail sales rising 5% to £455 million, and all 4 product divisions, women's wear, menswear, accessories, and children's wear, growing simultaneously for the first time since 2023. The market's response was to sell the shares down nearly 6%. That is the tension at the center of this trading update, and the bottleneck lies not in the headline number, but in where that growth is coming from, and whether it can hold without the one geography that is still missing. America's comparable sales rose 12%, and Greater China climbed 9%, delivering the headline beat. But EMEIA, which includes Europe, the Middle East, India, and Africa, fell 3%, with management attributing the decline to lower tourist spending caused by the US-Iran conflict. Even excluding the Middle East entirely, EMEIA was still down 1%. 2 days before this update, 37% of Burberry investors had voted against the CEO's new pay package at the annual general meeting, a signal that a portion of the shareholder base already distrusts whether the turnaround is durable enough to justify the reward structure. That same cohort sold again on Friday, despite results that met internal forecasts. The question the sell-off is asking is specific. Are Americas and China filling a hole left by absent European tourists, or are they genuinely new demand that Burberry would retain even if EMEIA recovered? Morgan Stanley called it a further solid step in the right direction, while Morningstar noted there was no sequential acceleration from the fourth quarter. The same 5% figure produced opposite conclusions in the analyst community, and that unresolved disagreement is precisely what is holding the shares below the January peak of 1,377 pence.
The CFO, Kate Ferry, was explicit on the earnings call. The Middle East itself represents only 2% of Burberry's total revenue. The real damage is not direct exposure to the conflict zone, but its tourism effect. Asian visitors who previously routed through Dubai and the Gulf are not coming to Europe either, and that suppresses spending across London, Paris, and the broader EMEIA corridor. CEO Joshua Schulman put a figure on the structural loss. Toura's business is down 50% since 2019, and he attributed that decline largely to the removal of the VAT refund scheme in 2020 under the Conservatives. The Iran war has worsened what was already a structurally impaired EMEIA business. This is the reinterpretation the surface reading misses. Most commentary frames EMEIA weakness as a geopolitical problem, the Iran conflict, which implies recovery requires a peace settlement that Burberry cannot influence. But Schulman's own statement locates the structural cause elsewhere, UK tax policy. EMEIA, excluding the Middle East, fell 1% even as the war effects were already known and priced by partners. The tourism floor is lower than it was before the conflict because a fiscal change 6 years ago removed the mechanism that made London shopping competitive for international luxury buyers. The contrast sharpens when read at the product level. The Portraits of an Icon campaign, featuring Daisy Edgar-Jones, Kristen Scott Thomas, and Matthew McFadden, brought 19% more new customers to Burberry's rainwear category and drove outerwear to double-digit growth. That is a brand momentum signal, not a substitution effect. Domestic and local consumers in the Americas and China are actively choosing Burberry's trench coat and outerwear. Japan, however, fell 2%, precisely because Chinese tourist inflows have not recovered, while South Korea rose 11% on a mix of local and inbound spending. The geography of the miss is tourist-dependent, not brand-dependent. The brand is working where consumers can reach the stores.
On the same day Burberry published its trading update, Andy Burnham was confirmed as the new Labour leader and will become UK Prime Minister on Monday. Schulman used Friday's earnings call to appeal directly to the incoming government, asking Burnham to restore the VAT refund scheme that allows overseas visitors to reclaim the 20% levy on luxury purchases made in the UK. The scheme was abolished by the Conservatives in 2020, and Schulman directly connected that decision to the 50% drop in tourist business since 2019. This is not a background political comment. It is Burberry's management stating that a specific recoverable policy variable is suppressing a material portion of their addressable revenue. The buried assumption in the bear case on Burberry is that EMEIA weakness is a demand problem, that European luxury shoppers have permanently reweighted their spend toward French and Italian houses. But the articles do not support that reading. Excluding the Middle East, EMEIA declined only 1%, and that is against a baseline already depressed by 6 years without a VAT refund. Burberry's Yorkshire manufacturing base, its Castleford trenchcoat plant, and its London flagship network are all operating below the tourist throughput they were designed for, not because of brand failure, but because the mechanism that made UK luxury spending attractive to overseas visitors was removed by a policy choice that the next government could reverse. The condition is now concrete and binary. If Burnham's government restores the VAT refund scheme, Burberry would be the single largest immediate beneficiary among UK luxury names. Its turnaround is demonstrably working in demand terms, and the structural tourist floor would rise. If no policy change follows, the Americas and China must sustain the full load of growth alone, which requires consistent local demand at 9 to 12% quarterly run rates without the portfolio balance that a recovering EMEIA would provide.
The technical picture adds context to the fundamental disagreement. Burberry shares have retreated from a January peak of 1,377 pence to around 1,060 pence, trading below both the 50-day and 100-day exponential moving averages, with a descending triangle formation and critical support at 1,025 pence. Morningstar maintained a fair value estimate of 1,370 pence after the update, characterizing the shares as undervalued. Bernstein described the quarter as evidence that Burberry has successfully completed its first brand revival chapter. But the absence of sequential acceleration from Q4, the 5% comparable growth matched, not exceeded, the prior quarter, is what gave investors who wanted an upgrade reason to exit. For a holder, the posture is to watch EMEA comparable sales, excluding the Middle East, in the Q2 FY27 update. If that line returns to growth, it confirms the tourist floor is beginning to recover independently of the Iran conflict, and the full-year revenue growth and margin expansion guidance becomes credible without policy help. A holder who exits here is betting that Americas and China cannot sustain double-digit growth alone, a bet the current evidence does not clearly support. For a watcher considering entry, the condition is the same EMEA x me print, but the additional trigger to watch is any signal from the Burnham government on the VAT refund. Even a consultation announcement would shift the probability mass toward EMEA recovery. The move becomes an entry setup if Q2 EMEA x Middle East returns to positive, and Americas holds above roughly 8% comparable growth. It becomes a value trap if Americas comparable sales decelerate below that level, while EMEA remains negative, confirming that the current results are a substitution effect, not structural demand. The single metric that decides it earliest is the Q2 trading update, expected in October, before the full-year results in May 2027.